Imagine waking up one morning, opening your bank app, and realizing that the system has been watching the movement of your money in a way most people never think about. Not only the big wire transfer, not only the sale of an investment, not only the deposit you made after selling a car, every deposit, every withdrawal, every transfer, every pattern. Now imagine that you are retired, you are living on money you earned over a lifetime, you are trying to manage your savings carefully, you move money from one account to another when a medical bill comes due. You take a distribution when the roof needs to be repaired. You send money to a child or grandchild because family is one of the reasons you saved in the first place. And then you learn that a number most Americans have heard about for decades may now mean something very different. That number is $10,000 for a long time. Many people thought the $10,000 rule was simple. They thought it only applied to criminals, smugglers, tax cheats, or people walking into a bank with a suitcase full of cash. They thought ordinary retirees did not have to think much about it. That assumption is becoming more dangerous. The risk is not that every person who moves $10,000 is doing something wrong. The risk is that the modern financial system does not begin by knowing your character. It begins by seeing your data. It does not know that you taught school for 35 years. It does not know that you paid your taxes. It does not know that you are helping your daughter with a down payment or paying a surgeon or moving proceeds from the sale of a house. It sees amounts, it sees timing, it sees patterns, it sees whether the number is above or below a threshold. Then it sends that information into systems that can trigger reviews, letters, audits, freezes, or worse. That is why this matters so much for seniors. If you are over 60, this is not an abstract policy debate. This is about how you move the money you spent your life earning. It is about Social Security deposits, pension income, retirement account distributions, family gifts, home sales, inheritances, medical costs, and ordinary cash management that can now look suspicious to a machine that does not understand context. The mistake most people make is thinking the danger is the transaction itself. It usually is not. The danger is an innocent transaction that cannot be explained cleanly when the system asks for an explanation. That is the difference between inconvenience and real trouble. Let me explain it through Patricia. Patricia is 71 years old. She is a retired school teacher in Ohio. She is not wealthy in the way Wall Street uses the word. She is careful. She is disciplined. She has enough to live with dignity because she saved, avoided big mistakes, and managed her life with common sense. Every month, her Social Security check goes into her bank account. She has a modest pension. She has some savings. She has an IRA. She has a small emergency fund because she was raised to believe that you never know what life will do next. For years, Patricia handled money the way many retirees do. When a larger expense came up, she moved money from savings into checking. When her roof needed repairs, she paid the contractor. When a medical bill came in, she covered it. When a grandchild needed help, she helped. None of this was complicated in her mind. It was her money. She earned it. She saved it. She moved it when life required her to move it. But under the way bank reporting and IRS data systems now operate, Patricia's innocent behavior can start to look like a pattern. Not because she is hiding money, not because she is evading taxes, not because she is doing anything criminal, because the system is built to notice financial movement before it understands financial purpose. That is the first principle to understand. In modern finance, your intent is not the first thing the system sees. The first thing it sees is the pattern. To understand why this has become such a problem, you have to go back to the rule itself. The $10,000 bank reporting threshold comes from the Bank Secrecy Act of 1970. That law was created during a very different time, for a very different kind of financial world. The idea was to help the government detect money laundering, organized crime, drug trafficking, tax evasion, and other activity that genuinely needed to be watched. Under that system, banks were required to file a currency transaction report when a customer deposited or withdrew $10,000 or more in cash. At the time, $10,000 was a very large amount of money. It was not the cost of a used car. It was not a routine contractor bill. It was not a medical expense that could arrive after one bad diagnosis. It was not a normal retirement distribution. In 1970, $10,000 represented a serious financial event. It was more than many people earned in a year. Adjusted for inflation, it is roughly the equivalent of about $80,000 today, but the threshold did not move. That is the root of the problem. The world changed, the prices changed, the size of normal financial transactions changed, the rule did not. When a number sits still for more than 50 years, while the cost of everything rises around it, the law silently expands without Congress needing to rewrite it. What was once a net designed for large criminal transactions starts catching ordinary middle-class life. That is how systems become dangerous without anyone announcing a new danger. In 1970, a $10,000 transaction was unusual. Today, for a retiree, it can be a roof, a used car, a medical bill, an IRA distribution, a family gift, a home repair, a downsizing move, or money received from an estate. The same number now captures a different population. That is the second principle. When a threshold is not adjusted for reality, reality eventually turns ordinary people into compliance risks. Most people know something vague about large cash transactions being reported. What they do not understand is that there are two kinds of reports that matter. The first is the currency transaction report. That is the report filed when a cash transaction crosses the $10,000 line. The second is the suspicious activity report. That one is more complicated and, in many ways, more dangerous because it is not limited to one clean threshold. A bank can file it when it believes activity looks suspicious, unusual, inconsistent, or potentially connected to something improper. And one of the biggest triggers for suspicion is structuring. Structuring means breaking up transactions for the purpose of avoiding the reporting requirement. If someone has $27,000 in cash and deliberately deposits $9,000 on Monday, $9,000 on Wednesday, and $9,000 on Friday because they do not want the bank to file a report, that can be a federal crime. The problem is that innocent people often create similar patterns without knowing the rule exists. A senior might deposit smaller amounts because they feel safer moving money. Gradually, a widow might keep cash at home because that is how her family always handled money. A retired small business owner might deposit money in chunks because he does not like walking around with large sums. A grandparent might give family members several smaller payments because it feels less dramatic than one larger transfer in their minds. They are being careful to the system. They can look like they are avoiding a threshold. That distinction matters because the law does not only care about whether the money is clean, the money can be completely legitimate. It can come from a home sale, an inheritance, a pension distribution, a legal settlement, a business sale, or decades of savings. If the pattern suggests that the person was trying to avoid a reporting requirement, the system can treat the behavior as the problem. That is hard for honest people to understand because honest people assume clean money means safe money. But under these rules, clean money moved in a suspicious pattern can still create a serious problem. That is why seniors are vulnerable. Many older Americans grew up in a different financial culture. They trusted paper records, they liked cash. Some distrusted banks because they lived through periods when banks failed, inflation surged, or institutions disappointed them. Some learned from parents who survived the Great Depression. Some simply managed money in small, conservative steps because that was their habit. Habits that once looked prudent can now look suspicious, and the system does not stop to ask whether the habit came from fear, discipline, family tradition, or financial caution. It sees the pattern first. There have been real cases documented by civil liberties groups where ordinary citizens and small business owners had bank accounts seized because their deposits looked like structuring even though they were not charged with crimes. The government did not have to prove a criminal conviction before the money was taken. The account holder then had to fight to get the money back. That process can be devastating for anyone. For a retiree, it can be catastrophic. Because if you are 71 years old and living on a fixed income, losing access to $20,000 or $30,000 for months is not an inconvenience. It can mean missing medical payments. It can mean delaying home repairs. It can mean hiring lawyers with money you needed for living expenses. It can mean anxiety that affects your health, your family, and your sense of safety. This is why the issue is not just financial, it is psychological. After a lifetime of working and saving, many people do not expect to be treated like suspects when they move their own money. They expect the system to distinguish between a criminal and a retired teacher. But systems built on thresholds and patterns are not always good at human judgment. That brings us to what is changing as we move into 2026. The $10,000 threshold itself has not suddenly become new. The rule has existed for decades. What is changing is the environment around it. The government has more data. Banks have more sophisticated monitoring systems. The IRS has more advanced tools for cross-referencing reported transactions against tax returns, income patterns, account flows, and other financial records. The direction of the system is toward more automation, more pattern recognition, more data matching, and more scrutiny of discrepancies. This is the third principle. A rule becomes more powerful when technology makes enforcement cheaper. 50 years ago, a report might sit in a file and never be meaningfully analyzed unless there was already a reason to look. Today, data can be sorted, matched, flagged, and compared at scale. That does not mean every reported transaction leads to an audit. Most do not. The volume is too large and many reports are ordinary. But the risk is not zero, and the risk rises when your financial pattern does not match what is clearly explained on your tax return or in your records. If you receive a large retirement distribution and it is properly reported, documented, and reflected in your tax paperwork, that is one situation. If money appears in your account and the records are incomplete, inconsistent, or confusing, that is another. The transaction might be innocent in both cases. The outcome can be very different. That is why the most important word in this entire issue is not fear. It is clarity. Clarity is what protects you. Now let us walk through the specific ways seniors can be affected. The first area is Social Security, pensions, and retirement distributions. Most monthly Social Security payments are not near $10,000. Many pension payments are not either, but seniors often take larger distributions from retirement accounts, especially required minimum distributions, annuities, inherited retirement accounts, or periodic withdrawals, used to pay for large expenses. A required minimum distribution from a larger IRA can easily cross the threshold. A lump sum withdrawal for medical care can cross it. A1. Time transfer to cover a home renovation can cross it. That does not mean the transaction is wrong, but it does mean the transaction should be explainable. If your tax return is complete and your records are clean, the transaction should fit into a logical financial picture. If the return is confusing, if the account movement does not align with reported income, or if there are multiple cash-like transfers that lack documentation, the system may ask questions. The mistake is not taking the distribution. The mistake is taking it casually without records, and assuming that because it is your money, no one will ever ask you to explain it. The second area is family gifts. Seniors help family members all the time. They help grandchildren with tuition, they help adult children with down payments, they pay medical bills, they give early inheritances, they provide support during divorce, unemployment, illness, or emergencies. This is legal. It is also emotionally natural, but large gifts have rules. They may need to be tracked. They may require gift tax documentation even if no gift tax is ultimately due. They can create questions if the source of funds and the purpose of the transfer are not clear. A grandfather who gives $20,000 to a granddaughter for school is not doing something suspicious in ordinary human terms. But if the money is moved in cash, broken into smaller pieces, passed through multiple accounts, or not documented, it can become suspicious in system terms. Those are not the same thing. Human meaning and system meaning can diverge. Good planning closes that gap. The third area is home sales and inheritances. These are some of the largest financial events seniors experience. A person sells a house after living in it for 40 years. The proceeds may be hundreds of thousands of dollars. A spouse dies and money moves from one account to another. An estate distributes funds, a senior downsizes, pays off a mortgage, moves closer to family, or shifts assets into a safer account. All of that is normal. But large lump sums create reporting trails. They need paper trails, closing statements, estate documents, bank records, beneficiary paperwork, retirement account statements, and tax records matter. When these documents are organized, a large movement of money becomes easy to explain. When they are missing, scattered, or never saved, the same movement becomes harder to defend. That is the difference between a clean financial event and an unnecessary compliance problem. The fourth area is everyday senior finances that have become larger because life has become more expensive. This is the quiet part of the problem. A roof can cost more than $10,000. A used car can cost more than $10,000. Dental work can cost more than $10,000. A medical procedure can leave a bill over $10,000. Helping with rent, a wedding, or family support can cost $10,000. Selling jewelry, furniture, a vehicle, collectibles, or equipment can create cash inflows that used to be unusual but are now common. A retired landlord collecting rent might see recurring deposits that look like business activity. A senior temporarily holding money for a family member may think they are helping while the system sees unexplained flow. Through activity, the rule did not adjust. Life did. That mismatch is what makes retirees vulnerable. Now let us talk about what happens when a report is filed. This is where people often imagine something dramatic. They picture agents at the door. That is not how it usually works. When a bank files a currency transaction report or suspicious activity report, the information goes into federal financial reporting channels, including FinCEN, the Financial Crimes Enforcement Network. From there, it can be available to agencies that use financial data for tax and law enforcement purposes, including the IRS in most cases. Nothing happens to the customer immediately. No one calls, no one sends a letter, no one explains that a report was filed. That silence can make people think there is no system behind it. There is. The report can sit in a database. It can be cross-referenced later. It can become relevant if your return is examined, if a pattern appears, if another report is filed, or if your transactions do not align with the income and explanations available to the government. That is why the danger is cumulative. One transaction might not matter, a report might not matter today. It might matter later when combined with other data. That is how modern systems work. They accumulate information and look for mismatches. If the IRS decides to look more closely, the first step may be a letter asking for documentation or clarification. That is often manageable if you have records. It becomes stressful when you do not. In more serious cases, it can become an audit. In the most serious cases, especially when structuring is suspected, it can lead to civil asset forfeiture. Civil asset forfeiture is one of the most disturbing parts of this system for ordinary people because it reverses the emotional logic most Americans expect. People assume that if the government takes your money, the government must prove you committed a crime. In civil forfeiture, the process can begin based on suspicion that the money is connected to unlawful activity. Then the burden can effectively fall on you to fight for the money back. That fight can take time. It can require lawyers. It can cost more than many seniors can comfortably afford. And even when the person ultimately proves the money is legitimate, the damage may already be done. This is why the real goal is prevention. You do not want to win a fight with the system if you can avoid getting into the fight in the first place. That brings us to the protection moves. The first protection move is simple, but most people do not do it. Keep records before you need them. Not after a letter arrives, not after a bank asks questions, not after a family member forgets why money moved. For every meaningful transaction, save the documents. If you sell a home, keep the closing statement. If you receive an inheritance, keep estate documents and transfer records. If you take money from a retirement account, keep the statement showing the distribution. If you give money to a family member, note the date, amount, recipient, and purpose. If you sell a car or personal property, keep the bill of sale and any messages or receipts. A notebook is better than memory. A spreadsheet is better than scattered paper. A folder with dated documents is better than both. The point is not complexity. The point is contemporaneous explanation. That means you wrote down what happened when it happened, not 2 years later when you are trying to reconstruct it under stress. This one habit can change everything because the IRS cannot easily turn a clean documented transaction into a mysterious one. The mystery is what creates the risk. The second protection move is to work with a professional before large events. Not only after problems, this matters especially for retirees because retirement finances are not simple. Social Security, pensions, IRA distributions, required minimum distributions, annuities, capital gains, home sales, inherited accounts, gifts and medical deductions can interact in ways that are easy to misunderstand. A good tax professional or enrolled agent who understands senior finances can help you make transactions clean, legal, and explainable. This does not mean you need someone to approve every normal bill. It means that when a large move is coming, a home sale, an inheritance, a large gift, a major retirement distribution, or a substantial cash deposit, you should make sure the records and tax treatment are clear before the money moves. The third protection move is to avoid any appearance of structuring. This is extremely important. If you need to deposit $15,000, do not divide it into $7,500 today and $7,500 next week simply because you are trying to stay below a threshold. That is exactly the wrong instinct. If the transaction is legitimate, it is usually safer to make the transaction cleanly, let the required report be filed, and keep documentation. A properly documented large transaction is generally less dangerous than a series of smaller transactions that appear designed to avoid reporting. This is the opposite of what many cautious people believe. They think smaller is safer. In this area, smaller can look more suspicious if the pattern has no clear business or personal reason. The fourth protection move is to use traceable payment methods when possible. Cash is not illegal, but cash creates more questions because cash has weaker context: checks, wires, electronic transfers, and institution. To-institution movements often create clearer records. If you are helping a child with a down payment, a wire from your account to the closing agent with a memo and supporting gift documentation is much cleaner than handing over bundles of cash or moving several smaller payments through informal channels. If you are paying a contractor, a check with an invoice creates a record. If you are receiving money from the sale of property, documentation and traceable deposit methods matter. The principle is simple. The more a transaction explains itself, the safer you are. The fifth protection move is to make sure family members understand the rules. Many problems begin with good intentions inside families. An adult child deposits cash into a parent's account every month to help with expenses. A parent moves money through a child's account because the child is more comfortable with online banking. A grandparent gives several smaller gifts because the larger gift feels too noticeable. A family member asks an elderly parent to hold money temporarily to the family. These are acts of trust to the system. They can look like unexplained movement of funds. This does not mean families should not help each other. It means the help should be structured, clearly documented, and preferably moved through traceable methods. If a family member is helping an elderly parent manage finances, legal authorization matters. A power of attorney or similar document protects both sides. Without proper authority and records, even innocent assistance can become confusing later. The sixth protection move is to understand your rights. If the IRS contacts you, do not panic. Do not ignore the notice. Do not call and improvise a story from memory. Do not try to be clever. Get the letter, read it carefully. Gather documents, contact a qualified tax professional or tax attorney, respond in writing when appropriate. Preserve records, keep copies of everything. Most issues involving bank reporting can be resolved when the facts are clean and the documentation is available. But ignoring a notice can turn a small issue into a large one. Responding emotionally can make it worse. Guessing can create inconsistencies. The principle is slow down, document, and get help. There is another layer to this issue that must be discussed honestly, and that is the feeling many retirees have when they learn how this system works. They feel watched, they feel distrusted, They feel that after decades of paying taxes, obeying laws, and living responsibly, they are being treated as if their normal financial life is suspicious. That feeling is understandable. There is a real tension between financial crime prevention and financial privacy. Governments want to detect crime. Individuals want freedom. Banks want to avoid liability. Retirees want to access their money without being treated like criminals. Those interests do not always align. When institutions become afraid of missing suspicious behavior, they often over-report. When technology becomes cheap, monitoring expands. When thresholds stay frozen for decades, ordinary life gets pulled into systems built for extraordinary activity. Understanding this does not mean you accept it as fair. It means you stop being blind to it. In my experience, the people who get hurt most by systems are not usually the people who understand them and disagree with them. They are the people who do not understand them at all. Knowledge is not paranoia. Knowledge is protection. There is also the issue of cognitive decline and senior vulnerability. This is not comfortable to talk about, but it is important. As people age, some become more dependent on family members, caregivers, or advisors. Some set up automatic transfers they later forget. Some allow others to manage accounts without clear documentation. Some are targeted by scammers who pressure them to move money quickly, secretly, and often in amounts designed to stay below reporting thresholds. This can create a dangerous overlap. A senior can be a victim of a scam and still create transaction patterns that look suspicious. A person who is manipulated by a criminal may withdraw money, send cash, buy gift cards, make transfers, or break up payments in ways that resemble structuring. That is why urgency and secrecy are red flags. If anyone asks you or a senior you love to move money quickly, keep it secret. Avoid the bank asking questions or divide payments into smaller pieces. Stop, slow down. Call someone trustworthy, talk to the bank, talk to a professional. A legitimate financial transaction can survive a pause. A scam usually cannot. Families should also plan before decline becomes a crisis. Proper powers of attorney, trusted contacts, clear records, and shared understanding of financial routines can prevent confusion later. This protects the senior. It also protects the helper. The next issue is advocacy. It is reasonable to ask whether the $10,000 threshold should still be $10,000 after more than half a century of inflation. It is reasonable to ask whether civil asset forfeiture gives the government too much power over ordinary citizens. It is reasonable to ask whether financial privacy is being weakened by technology faster than the public understands. Those are legitimate questions. Seniors have political power. They vote, they organize, they influence families. If the system is unfair, citizens can push for change through elected representatives, advocacy groups, and public pressure. But while policy debates continue, individuals still have to live under the current rules. That is why I separate two things. One is what the rules should be. The other is how to protect yourself under the rules that exist. Confusing those two can be costly. You can believe a system is unfair and still document your transactions. You can oppose overreach and still avoid structuring. You can support reform and still keep clean records. Principles are important, so is practicality. Looking ahead, the direction is clear, even if specific rules continue to change. Financial systems are becoming more data-driven. Government agencies are becoming more capable of cross-referencing information. Banks are becoming more cautious. Payment platforms are becoming more reportable. Automated analysis is becoming more common. This trend does not depend entirely on one election or one administration. Technology itself pushes the system in that direction because once data exists, institutions find ways to use it. That means the habits I am describing are not temporary. They are not just for 2026. They are part of responsible financial management in the modern world. Keep records, move money cleanly. Do not create suspicious patterns. Use traceable channels. Document family assistance. Get professional guidance before major financial events. Know your rights. Stay informed. That is not fear, that is preparation. The most dangerous retiree is not the one who has a large transaction. It is the one who has a large transaction with no explanation, no record, no plan, and no understanding of how the system sees it. A $20,000 documented IRA distribution used to pay for a home repair is one thing. 3 cash deposits just under $10,000 with no clear record are another. A properly documented gift to a grandchild is one thing. A series of informal transfers through multiple family accounts is another. A clean home sale deposit supported by closing documents is one thing. A large unexplained cash inflow is another. The facts may be innocent in every case, but the system does not experience your innocence. It reads your records. That is the final principle. In a data-driven financial system, your records are your voice. If you do not keep them, the pattern speaks for you, and the pattern may tell the wrong story. Patricia's story matters because she represents millions of people who did everything right in the old world and are now operating inside a new one. She is not trying to beat the system. She is trying to live. She wants to pay bills, support family, visit grandchildren, maintain her home, and enjoy the retirement she earned. But the rules around money movement have become more complex. and the systems watching those movements have become more powerful. The solution is not to become afraid of your bank account. The solution is to become more deliberate. Before a large transaction, ask yourself a few questions. Can I explain where this money came from? Can I explain where it is going? Do I have documents? Would the pattern look strange to someone who does not know me? Am I dividing this transaction for a real reason, or only because I am afraid of a report? Would a check wire or documented transfer make this cleaner? Does my tax professional know about it? Has my family documented what they are doing? These questions are simple. They create a system of personal protection. And systems matter because willpower and memory fail under stress. A clear system protects you when your emotions are high, when a bill arrives unexpectedly, when a family member needs help, or when a bank asks questions you did not expect. The $10,000 rule is real. The reporting system is real. The risk of seniors being misunderstood by automated patterns is real, but so is your ability to reduce that risk dramatically. You do it by making your financial life explainable. That is the heart of the matter. Not secretive, not clever, not fearful, explainable. A lot of people think privacy means opacity. In practice, for retirees managing significant money, safety often comes from clarity. You want the right people, your bank, your tax professional, your family where appropriate, and your records, to be able to understand what happened and why. That does not mean surrendering your independence. It means protecting it. Because independence without preparation can become vulnerability. If you have spent a lifetime building savings, you should not lose sleep because the rules are confusing. You should learn the rules, build the habits, and keep your money moving in ways that are lawful, documented, and consistent with your actual life. This is not about assuming the worst. It is about recognizing how systems behave. Systems do not care about your intentions until you can prove them. So make your intentions easy to prove. That is the calm, rational way to deal with this. Do not panic. Do not ignore it. Do not let fear push you into hiding or breaking transactions into smaller pieces. Do the opposite. Bring order to your records. Bring clarity to your transfers. Bring professional advice into large decisions. Bring your family into the conversation before confusion begins. And when a meaningful amount of money moves, make sure the story of that money is written down before anyone else tries to write it for you. You worked for that money. You saved it. You have the right to use it. But in the financial world we now live in, rights are protected best when they are paired with records, discipline, and an understanding of the system. That is how you avoid becoming Patricia. That is how you keep an ordinary transaction from becoming an unnecessary problem. And that is how you continue managing your retirement with the confidence that comes not from hoping the system understands you, but from making sure it can.